Hello everyone and welcome into the channel. My name is Brent, and in today's video we're going to go ahead and cover this weekly's change in news out there in the markets for 3 March to 7 March 2025. We're going to go ahead talk a little bit about the fear index, unemployment, mortgage rates, the tariffs that went into effect here in early March, and other tariffs that will go into effect in April. So we'll go ahead and chatter a little bit about the Magnificent Seven as well. So definitely stay tuned. And I think that will wrap it. So if you guys are brand new here to the channel, definitely go down below, hit that subscribe button, and give this video a big old thumbs up. Also, drop me a comment at any time if you guys have any comments, questions. I do always appreciate feedback and comments that I can read and reply back to. I always do that. So with that said, let's go ahead and get into it. Okay, so fear index. As of a month ago, we were in fear territory with tariffs already being in the highlight, unemployment beginning to tick up. We also saw January, February, we had foreclosures kind of spiking a bit, and we were in fear as of a month ago. And as of February 26th, I believe it was, let's quickly look at my calendar here. Yeah, February 26th, we began to fall within the S&P 500 very quickly. Oh, February 19th. It's just been on a downtrend for the past 2 and a few days, with only Wednesdays and Fridays really sort of living, sort of having any sort of positiveness in the market. So if we take a look at the indicators here as to what is causing the extreme fear, you can see that there's 7 fear and greed indicators. One that uses market momentum. Right now, market momentum is to the downside. The S&P 500 has been in a straight decline now for over 2 weeks, ending this week alone over 3.32% into the red this Friday. We did have a bit of an uptick here on Friday, but we'll go ahead and chatter about that here in just a minute. So back over here, we also have stock price strength. A lot of companies out there, including the Magnificent Seven, half of them are already trading well below their 200-day moving average with no sort of support in sight. So this is driving other stock prices in the total market to come down, and it's barely hanging on just slightly above its 200-day moving average, where it's acting as support right now, but could act as resistance if it continues to fall, which I believe it will. We'll go ahead and cover that here as to why. Stock market breadth. As far as indicators go, there's more outflow of shares than inflow of shares. People are more likely to, there's very low volume. They're also getting out of their shares, so they're selling out at a more positive rate than they're buying at the moment. So there's definitely more fear and greed out there as far as trading volumes. Puts and calls. Normally in an uptrend market, there's a lot more call options because you're doing out of the money call options. So the upside, expecting that the market will move higher and higher, versus right now, you can see here as of February 20th, there's been an increase in the puts to call ratio. So right now there's much more puts being into the market for more downside protection versus upside expectancy. Market volatility, we saw the VIX spike here as of February again. Safe haven stops, people are moving more to, into bond returns versus stock returns. So people are investing more into bonds as a safer alternative to stock market investing, and junk bond demand is currently on the lesser, extreme greed there in that market. Now, the next thing I wanted to kind of take a look at, we saw the fear indicator. So the next thing I wanted to kind of chatter about was unemployment. We did get the unemployment here. This is the data as of March 7th, Friday, March 7th. We did see the uptick. It's been on a pretty good uptick. This actually shows really well here in Google. I went unemployment rate, and we see here as of April 2022, it just been, well, maybe not then. I'm going to look at, right around October, 2022. It's been in this 3.5, 3.6 range. And then here, 2024, it's been on the slight uptick, actually breaking the 4% range here going into 2025. As of now, unemployment rate is showing at a 4.1. I've seen a ton of videos of individuals getting unemployed. They're getting either fired, laid off, And I'm making a video on some of the changes coming up with my own sort of changes, as I was recently laid off as well. So I'll be making a separate video as to that occurrence and how that's affected some of my investments going forward a little bit. But we'll talk more about that in a later video. But unemployment rate has definitely spiked up here in the short term. And it shows as of May 2023, unemployment rate, you can see it better here on this graph. They do a better graph here overall. You can see it kind of bottomed out right around that May-April period 2023, and just has been slightly upticking ever so slightly higher and higher. And in January and February, we did see, I believe this is going to play a part into foreclosures. We see I couldn't find any new data into March. So I tried looking around to see if there's any new foreclosure data here for March that's been released. But this article is from February 14th. So I expect that there's going to be some sort of an article for March, right around mid-March, that'll show the foreclosure rates for February. But there was an 8% increase from the previous month, but a 7% decline for a year over year. So month to month, it seems to be going higher, but year over year, there's just a slight decline. I know of a few foreclosures here where I live, where I actually know of a few individuals that are going into foreclosure and have seen a lot more signs and people listing their homes, trying to get out of their homes instead of sticking around and getting foreclosed on. So definitely something that's interesting. You can see in the red some of the harder hitting states that are going into foreclosure. So 1 in every 3,500. So definitely some interesting numbers here throughout the United States. I would like to see the numbers for February. I think that'll be interesting. I live over in Oregon. I don't know how many of individuals out there, but definitely it's been continuing. I think it's global or nationally, where it's just been a slow uptick throughout the U.S. with the rate of unemployment. And then home prices I know here locally where I live, just throughout Oregon, I've been watching housing prices. They have doubled since when I purchased my home. Purchased my homes back in like 2018. I purchased a couple of rentals, 2018, 2019, 2020. I bought my own house, another one. And then as of then, just prices had scaled very quickly into 2022, 2023 period. And then over the last year and a half or so, prices have kind of stagnated as interest rates have gone up. I believe I had an interest rate calculator here. I did have another one pulled up on another page. I've lost sight of it. I can't adjust going back, but back in 2020 to 2023, you would see interest rates of anywhere from 2 to 3%. And then 2023 going into 2024, that rapid increase in mortgage rates begins to rise. So a lot of homeowners, myself included, have these rates locked in at 2%, 3% rates. And that's driving a lot of individuals to not want to sell. They just want to hunker down, keep their low mortgage rates. Yeah, so blame homeowners clinging to those dirt cheap mortgage rates, such as back in 2020, 2022-ish area. Yeah, I have a 2.25% interest rate on my home. I'm going to be living my old ages in this house. So they're basically bolted in place. But there is an incline in a lot of other states. So I believe Texas and Arizona here through the article. Texas is drowning in listings. So they've done a whole lot of building in Texas and Arizona. And then they're showing that the sale pile is 20% above pre-pandemic days. So they're actually drowning in listings. They have so many listings that they don't know, there's more houses than buyers out there because of the current interest rates and how it's affecting people's ability to buy at the moment. If your rate is 6.5%, you don't have a lot of room versus if you have a rate in 2-3%. The buying power just very much decreases. it would be a huge difference today buying my home at a 6 to 7% rate versus that 2 to 3% rate. Just huge difference in mortgages. My friend who's buying a house which is almost $200,000 less than mine would have to pay nearly, I think it was $500 or $600 more just because of the interest rate alone over the period. So it is very interesting, and yeah, tough time for home buyers out there and those who are looking to sell and trying. They can't really sell because if they sell, they have to buy something else out there that's expensive. They're going to have to lock in a high rate, so they're locking in both a high priced because home prices haven't came down at all in the last 1.5 2 years. They've just kind of stagnated sideways, whereas rates have also stagnated sideways now, kind of maintaining. And then there's been an uptick in uh, stockpiled of housing, like housing itself has been going up. So Treasury came out Friday. I did have another article here with Powell. Where is it? The Fed chairman. I was actually watching Fed chairman talk on interest rates and what he thought of the economy and the current uncertainty in the market. And he had said, Powell, Powell here, it says right here, Powell said Trump's administration is making policy changes in several areas, including trade, taxes, government spending, immigration, regulation. And this overall adds a matter of uncertainty to the economy and the Fed's interest rate policy. So there's a ton of changes going on right now in the market, and many of those changes are very uncertain in how they will play out, not only short term but long term. So there's a lot of changes. Oh, there's another article out there. I don't have it up anymore about Bitcoin. I was going to talk about that. Bitcoin becomes established strategic Bitcoin reserve. There we go. I got that article pulled up on my screen. I'll bring that up over in a minute. But make sure everything's paused there. Yeah. Okay. So there's no expectancy of interest rates to come down because they can't jump at the step right now. Right now, the U.S. just needs to go to a detox period. This article kind of explains where Treasury State Stock Gazette said Friday the U.S. state economy has become increasingly resilient on excessive government spending. So government spending has been super high in the last few years, and here in 2025, it's getting thinned out by Doge. So right now, as Doge is doing its thing, thinning out the local government, thinning out the federal government, IRS, and all these branches of government where overspending has been really excessive over the last few years, it's going to go through a detox period. The market and the economy have been hooked, becoming addicted to excessive government spending, and there's going to be a detox period. We don't know how long it'll last, right? There'll be a natural adjustment as the Trump administration seeks to move the country towards private spending. And the American dream is to be able to buy a house, adding to the administration trying to get rates down. So how do you get rates down? You basically you have to get rates down by having a need for it. So the market's got to go down. Real estate's got to go down, stock prices got to go down, just prices got to go down and have a need for rates to go down. So that'll be an interesting time. Let's see. Next article, we kind of chatted a bit about Jerome Powell already. So there's already been, as of Tuesday, so most economics say that Trump's plan to slap tariffs on a wide array of imports, including 25% on goods from Canada and Mexico, has been partially delayed as of Thursday, but we still see that the market has been going down as of February 20. It was back here. Let's look at 1 month ago. Yeah, February 19th. We have a lot of stuff kind of going on right now with tariffs. They took into effect on Tuesday. It looks like Thursday they got postponed a bit, which kind of gave the market that 0.5% recovery there during the day. We also have the full tariffs. I don't know if that's in here, but there's supposed to be more tariffs. Go away. There's supposed to be more tariffs going into effect in April, sometime around the 4th. Yeah, this article actually did a really good job of not only covering tariffs, Jerome Powell, how he expects uncertainty. Right now, there's a lot of uncertainty here in the short term. Unemployment rate ticked up to 4.1. It does show that employers added 151,000 jobs. Consumer spending has begun to slow. Yeah, kind of an interesting time. I did have another article. Let's see if it's over this way. Oh, yeah, I think it was April 2nd. Ah, here it is. Okay. So this article here went and kind of talked a little bit about the tariffs that had been imposed on Canada and Mexico. There was a 25% tariff that had been imposed on Tuesday for some imports from Canada. But as of Thursday, there was a bit, the basic thing is they're insisting that this is going to help kind of stop this from coming into the States. So most of the tariffs will go in on the 2nd of April. Right now, there's some temporary ones. And yeah, they've got some chatter with Mexico that they're going to be making an exemption. And then Mexico said, thank you for that. Here over on this one. Oh, that's here. Yeah, Wednesday he said he would temporarily spare car makers 25% import. And then I think that's it as far as tariffs. So yeah, tariffs were the biggest thing this week as they went into effect Tuesday. And then they kind of eased off the pedal on Thursday, kind of let the market had a bit of a recovery. But I don't think that's going to be the short-term pain. I think there's going to be more pain in the following week as we end up closing or breaking below that 200-day moving average. And I'll go ahead and explain here why as we move into the next thing, talking about the Magnificent Seven. Okay, so one-day performance, we see that in the day of Friday, NVIDIA, Apple, Google were positive as of the main 7 that I generally look at. NVIDIA up 1.92, Apple 1.59, Google 0.88. Costco went down 6.07%, putting them negative for the year to date. Walmart down 3.8%. So we see that Friday, there was a bit of an uptick. So here you see quite a bit of green. That did cause the S&P 500 on Friday to end positive by 0.55%. But we did see intraday that the S&P 500 had actually ticked below that 200-day moving average. So here I have the S&P 500. I got percentages in. Let me go ahead and turn these off. Normal. Okay, back over here. So S&P 500 on Friday. I can't bring up the S&P 500 here, so I'm just using SPY here. So 571, I have SPY here. Let's look at intraday. Oh, here it is. Yeah. So 571 is that 200-day moving average. So intraday Friday, the S&P 500 did break below that 200-day moving average twice. And then I put in a buy. I was trying to buy UPRO. It's a 3 times leverage fund for the uptick. So I did expect there to be a bit of a bounce here. I don't know if there'll be a continued bounce on Monday and the following week. Generally, the last 2 weeks, Monday, Tuesday, have been negative. Wednesday's been a bit of a recovery. So if we look at 1 month, so here, as of the downtrend, you'll see negative, negative, negative here. Wednesday, Tuesday into Wednesday was an uptick of 0.5. Friday is generally an uptick. So Thursday into Friday, there's an uptick of 1.56. Again, here, the second week, we have Tuesday into Wednesday, uptick of 1.07. And then Friday here, Thursday into Friday, we did see that uptick of 0.55%. So generally, the trend's been negative Monday, Tuesday. So we'll see how Monday plays out in the following week. But so intraday, we did see the S&P 500 break below that 200-day moving average, but break above it as a bit of a bounce and move higher. Now, when looking at this, if we do break below that 200-day moving average that's currently acting as support, I believe it'll act as resistance. And I believe myself that we will actually break below that 200-day moving average here in the short term and will begin to trend a bit further south. I'm not sure how much further south that we may see the S&P 500 move, but I do expect there to be some more decline in the markets, even passing that 10% correction territory. So if we look at the 1 week performance, you're going to see a lot more red out there because the S&P 500 on the weekly basis dropped down 3.36%. So if I bring up the S&P, yeah, so this is the S&P 500 down 3.32%, SPY 3.36. It follows but very closely imitates the S&P 500 market. You know, not quite as perfect, but it's still pretty good. So both of them went down roughly 3.3%, we'll say, and then made that bounce back above that 200-day moving average before closing above it. But we can see for the week, we see a lot of red. Nvidia down nearly 10%, Broadcom 2.24, Apple negative 1.15, Microsoft down 0.93. Not the hardest hit here in the week, but they're so negative. We'll go ahead and talk about Microsoft being a fallen knife at the moment. Amazon down 6.14, Tesla down another whopping 10%, putting them down almost 35% year to date. Meta down 6.37, and Google positive for the week by 2.05. So now we want to talk about the year to date. Let's go ahead and take a look at year to date. So yeah, Tesla is sitting at that 35% negative year to date. That has a lot to do with the Doge and Elon Musk being part of that, and there's been, you know, quite a bit of fallback from that. You can see people. Microsoft down 6.69, Nvidia 16, Apple 4.5, Broadcom almost 16%, Amazon 9.18, and Google 7.71. So you see a good portion of the S&P 500 is green. You know, it looks like, 50-50. You're kind of looking at it. There's more green out there than red, but these 7 companies, the Magnificent 7, Microsoft, Nvidia, Apple, Google, Meta, Tesla, Amazon, they make up 30% of the S&P 500 themselves alone. So if these companies are not doing well and healthy, then the market is more than likely going to be downtrending. So what we're going to go ahead and take a look at here is these 7 companies and look at how they're trading right now. And I'm going to go ahead and say that you're not going to be happy with if you're owning Microsoft, Tesla, Nvidia, and potentially Google here going forward. Let's look at the 1 year. And just looking at the 1 year trend, Apple is actually doing fairly well. Of the 7, it has only broken now. Oh no, it had broken below that 50-day, but rose back above it, trading at 239. It still has a little bit to the downside protection where its 200-day moving average is 227. Apple does pretty well for itself all in all. So I don't see a lot of red flags with Apple if you're buying and holding Apple. I hold a good majority of Apple myself. I think it might be one of my biggest single holdings. Amazon, this one, it's kind of a risk on potentially. We don't know yet. But we see the pullback here in Amazon broke through that 50-day moving average. It did go all the way down, touched on Friday, below the 200-day moving average before coming back up above it. Now, if it does break below that 200-day moving average, which is acting currently as support, it could trend lower with no end in sight. You know, it could fall down into the 160s potentially if it doesn't keep above that support line of 199.03. So Amazon right now, I'm kind of watching this one. I'm going to go ahead and set my alert price right now, kind of just around 199. You see if it trends and closes below 199, I would like to see where this kind of bottoms out at. So Amazon's kind of on that risky edge. Google McDougal, it actually broke below its 50-day, broke below its 200-day. It's having a hard time right now. Once you break through that support line, it now acts as resistance. So that 177 that once thought, people could think of 200-day moving average as support, broke right through it. It's not going to be acting as resistance. It is trying to make some recovery back up to the upside. I saw a lot of investors making videos of being really happy to buy Google below $200, but you might get the opportunity to buy Google at 160, 150 here in the future if it is not able to break above that 200-day moving average and move higher. Meta here. Meta's not in a bad state. As we kind of saw earlier, Meta's been pretty positive year to date. We see Meta is one of the only ones of the 7 that's positive, up 6.86 on the year-to-date scale. It still has a long ways to go before even touching that 200-day moving average at 566. So Meta has some wiggle room here, and it does pretty good. Tariffs may not affect it as much as other companies such as Amazon that has products and services that might be affected by it. Google, I wouldn't think would be pretty affected by it, but Google, yeah, we'll see. We'll see. I don't have much to chatter about the business. Meta, I feel like it does really well. Now, talking about the negative side of the Magnificent Seven and what could be dragging the S&P 500 down into the incoming weeks here, right? So in the video here, we have it breaking the 50-day, we have it breaking the 200-day, we have it breaking the recent lows of whatever these lows are at. You can see here, as of Friday, it closed at a yearly low for the year at $112.69. Right now, this will act as a resistance here, that 127, that 200-day moving average will act as resistance. If you see that 50-day is about to cross below that 200-day, that is often a death cross, indicating it's going to be having a much harder time in the future. So anytime there's any sort of death cross here, so back in early 2022, we saw that death cross take place here in early 2022. Share price was only at that time, I think they probably did a stock split between here and there, so I can't tell you the exact numbers, but we see them drop down from 2022 into 2023 before they had any sort of uptick period. And this is all AI driven right here, AI, Bitcoin, all that stuff, right? So if this doesn't hold, right, we could see Nvidia pull back into that $80 mark, or even further down into those 2024. So I'm not sure exactly where this will take, where this will fall. Right now, there's no sort of stopping period where this is going to be like, hey, oh, there's some support right here, right? It could be support right around 90. It could be support at 80. I don't know. That could be a big driving factor for the S&P 500 and other markets just kind of going below that 200-day and again acting as resistance for the total market. Tesla, we already know Tesla is in a bit of a down state, dropping over 30% now, 35% year to date from those highs. Broke through that 50-day, broke through that 200-day. It doesn't have the death cross here in sight, but it's already broken below 262. That 281 is going to act as resistance. I do feel like Tesla still has more downside to go. It could definitely hit that $200 mark for sure. Right now, there's no sort of signage, signs that it will stop and slow down, right? You can see here, just the last time in mid 2024, it was trading at that $200 mark. So yeah, we could definitely see Tesla fall off a cliff, and that's going to affect the markets, right? As these 7 companies make up 30% of the S&P 500, if there's any sort of red and issues with these companies, it'll drive them down as well. Microsoft, I feel, is one of the more sort of daggerish falling knives out there. Tesla is the biggest falling knife. Microsoft is right behind it. We do have a death cross showing up on Microsoft here with that 50-day crossover, that 200-day. This has happened back 5 years ago. If we look at the 5-year period, we see here there was a death cross at that same time period as in 2022. I'm trying to go a little bit faster because I've been recording for 28 minutes and I know that dragging these out is often not good. Okay, so death cross here, early 2022, similar to what we saw with NVIDIA. This often leads to a downtrend leading into 2023. So here, as Microsoft has recently broke both below its 50-day and 200-day moving averages, and now there's a death cross here at 393, we could see that there is no support in sight for Microsoft. This could fall into the 360s. It could fall down into the 320s. It could fall even further into the 240s. Really, there's no end in sight in Microsoft outside of their earnings going well for them, and it did well, but everything's got to get pulled back. Rates, they want rates lower. They want the market to bleed a little bit. They want some pressure. Fed's not going to be making any changes unless there's a need for changes, and the only way that we're going to get a need for changes is by tanking markets, taking real estate fast and quickly, right? It's got to happen. We're ripping the Band-Aid off. So these three companies here are already in trouble. Google and Amazon are very much holding on for their safety, right? But they're very close. Amazon trading slightly above that 200-day. Google trading slightly above that 200-day. If these fall and join Nvidia, Tesla, and Microsoft, then you have 5 companies that have no end in sight, trading below that 200-day moving average, no sort of support lines to hold it up, and that will drive the S&P 500 and other markets below that 200-day, where that 200-day now acts, instead of support, it'll act as resistance. So overall, I do feel that moving forward through March into April, we'll definitely see some volatility out there. We'll have more downside. I don't know how much more downside, right? We can't look at the companies here. We can't look at Nvidia, Tesla, Microsoft, Google, Amazon, and know where their support levels at. So we don't know where the S&P 500 will have those support levels at. I do expect those companies, 5 companies right now of the Magnificent 7, to fall because of weakness in the market. So that'll drive the total S&P 500 lower, and we just have no stopping period, right? And then April 2nd, we have more tariffs going into full effect, which will continue to drive more uncertainty in the market. And uncertainty is negativity in the market. So nobody likes uncertainty. That's going to drive prices down as well. So total, we have unemployment spiking, foreclosures spiking a little bit, month over month. I believe it was month over month, may have been year over year. We have more houses sitting on the sidelines than buyers. We have a spike in housings, but less buyers. We're maintaining interest rates while they are slowly falling, but they're just kind of staggering sideways. Prices remain high on real estate and has stagnated a bit. So interest rates have stagnated, prices have stagnated. Nobody wants to sell their existing homes, but there's a lot of homes out there that are on the market, but just nobody's buying them, right? And then we have Jerome Powell, the Fed, coming out saying that, hey, there's no need to drop anything at the moment, make any changes. There is a lot of uncertainty that is being done in the markets, and it's going to continue to get worse before it gets better. So I believe going into the remainder of March into April, we'll definitely see the markets be a lot more rocky, and expect your portfolios to bleed quite a bit more. It'll be an interesting period. Definitely some buying opportunities out there if you have some money to invest in the markets. And then, as I said, I became unemployed in February. So that'll be an interesting period for myself included. And we'll chatter about that in another video. I have a whole video going over how I've made changes within my portfolio to kind of use that here as income, and we'll go over that here in another video. So that is going to be it. We've gone 33 minutes. Let me know down in the comment section below, what do you guys think about unemployment rates at the moment? Is that showing any sort of concerns out there for you in your area of work? Foreclosures, do you guys know of any friends, family, people that are going in the foreclosure? Housing markets looking like it's been stagnating sideways in your areas as well. What do you guys think about the Fed and S&P 500? So also let me know, what do you believe about the companies? Do you agree with me that you see Microsoft, Tesla, Nvidia kind of being fallen knives here in the short term? Amazon, Google could potentially be turning into one of those knives you don't want to hold on to, and then that could bring the whole market down with it. I don't know where the end will be, but I do expect more red. So let me know if you agree or disagree with me down in the comment section below. I would really appreciate you guys' feedback, and I will definitely reply back to you. Okay, that is it from me. I do appreciate everyone who has turned into this video. Definitely go down below, hit that subscribe button, and give this video a big ol' thumbs up. Share it with your friends and family and all that fun stuff. Just kidding. Okay, have a good one. Bye-bye.